Good morning, everyone, and welcome to our DAT IQ weekly market update. This is our update for December 6th, 2022. I'm Ken Adamo, Chief of Analytics here at DAT, joined by Dean Croak, who's our Principal Industry Analyst, and a very special guest. We have Christina Ellington, who's a Freight Market Analyst here at DAT. Good morning.
Good morning, Ken. Good to be with you. Good to have you with us, Christina.
Morning.
First time. Yeah, we've got like the dynamic duo of freight analytics here at DAT. It's quite an intimidating force to be pitted up against here.
Yeah.
So, Dean, I mean, I know you follow this super closely, but the Buckeyes have backed their way into the college football playoff.
Yeah, I read that on the weekend. I was kind of surprised at that. You said it was what was it, against all the odds or something to that effect?
I mean, I think the technical term is falling ass backwards into the playoff, but they will be playing Matt Clark's Bulldogs, right. Our friends and partners at OTR down in Atlanta, I'm sure will be there in attendance rooting against my Buckeyes, and they'll probably be on the right side of that. But another meaningful game. I'm happy for that.
Yeah.
What's going on in your world, Christina?
Oh, just waiting for more snow to come.
Yeah, we're spread out. Christina's in the Denver area.
Yep.
I'm in Ohio, and Dean's in Boston. So we've got the country pretty well blanketed here.
Yeah, but no snow in sight. We've got nothing here at all.
Just rain. It's just gray.
Yeah.
It's that gray season here in Ohio.
Yeah.
All right. So for those not familiar with our program here, we are here every Tuesday at 10 a.m. Eastern, going through key trends, looking at the data, not making ridiculous claims on Twitter. That's not our speed. But we are here to answer your questions. So if you have any questions, thoughts, or comments, or predictions about the Heisman or the playoffs, go ahead and drop those in the comment section or the chat, and our wonderful producer will get those pushed over to us behind the scenes. But with that, I'm going to go to our key points of the week. Maybe. All right. So a lot going on. So we're seeing that seasonal bump that we expected. So the rumors of the demise of peak are greatly exaggerated. We have been seeing 2 weeks now of pronounced strength in the spot market. We're identical to post-Thanksgiving 17 and 18 levels. Timing a bit off, it seems like, but still what we would expect. And I think some of this decline in fuel will be beneficial to those strength in spot rates. Intermodal ramp market's kind of just crazy numbers, right? Up 92% week over week over fears of that rail strike that was averted by government action. Not a phrase you hear that often. Active rates for van and reefer continuing downward on the contract side. We've been saying for months at this point that the market won't start to wholesale turn up until we see spot and contract equalize. So we expect that to keep going down until they catch up to spot rates. 196.7 million. Not a penny more or a penny less consumers shop over the Thanksgiving holiday weekend. By all estimates, Black Friday and Cyber Monday were the busiest on record. So again, the demise of the American economy perhaps not happening just yet. And then I think an interesting tidbit here, hurricane season ends as average, but one of the third most expensive to date. I'm sure Ian had a lot to do with that. So 0 named storms in August, but the first November hurricane in 40 years. So with that, I'm going to turn it over to Dean to walk us through our market update. Dean?
Yeah, thanks, Ken. We had a special request from John Pandal, Director of Special Projects. He asked if we could reschedule today's call because the World Cup is on. It's Morocco playing Spain live right now. He said props on the performance of the Socceroos. In fact, Australia did surprise all of us, have a lot of Asian countries so far. So with that, we will dive into it. Let's get into the market update. A couple of data points came in overnight. ACT Research, our data partner on the equipment side, released November truck orders up 271% year over year against very easy comps, though. Down 22% month over month. Trailer orders up 171% year over year and up 83% month over month. So carriers are still looking fairly bullish at 2023. Tim Denoyer from ACT Research will be our special guest on next week's show. Make sure you tune in. He'll break down all of November's numbers for us. So let's start with dry van load to truck ratio. The week after Thanksgiving is always a catch-up week following the prior short work week. Load posts are up 160% week over week, back over 1 million load posts for the first time in 2 months. The threat of the rail strike, though, was what really drove some of the volumes last week. It sent a lot of volume over to the intermodal volume to the truckload market. I had a look at our top 10 intermodal ramp markets that truckload competes with. Truckload load post volumes are up 92% week over week, but a bit more on that later. Carriers returned to the market after the holiday break, and even though equipment posts were still at the highest level in 6 years, volumes dropped by 16% compared to the week before Thanksgiving, when it was a normal work week. That indicates to us that the spot market capacity did tighten last week on higher load volumes. Rates will be up as we get to the latter part of this update. Load to truck ratio almost doubled last week from 2.13 to 4.49. In the refrigerated sector, load posts were at their highest level in 8 weeks, following last week's 117% increase. Week over week, that is. Volumes have increased 22% in the last month and are tracking closely with 2019 post-Thanksgiving levels. No surprise with any of these numbers. That's pretty much what we would expect with seasonality this time of the year in the refrigerated market. Last week's load post volumes, though, are still 51% lower than this time last year. Carrier equipment posts bounced back. They were up 24% last week. Load to truck ratio was up about 75% from 3.51 to 6.10. And in flatbed, load posts more than doubled last week and unexpectedly were at the highest level in a month. Volumes are still about 69% lower, though, than this time last year, but trending about 6% higher than the oversupplied truckload market in 2019. Equipment posts were at their highest level in 6 years, like the other two sectors, 5% higher than 2019 levels, though. Load to truck ratio up about 110%. It was up from 2.14 to 4.49. So having a look at some of our markets, even though the rail strike threat was averted last week, it didn't stop shippers from taking preventative measures and diverting some volume to truckload. It's a really good story on CNBC. I think Lori-Ann Rocco wrote the story. She interviewed DHL Global Forwarding. They were reporting that supplies of critical semiconductor chips, vital to the economy, of course, shifted to truckload. Mostly high-tech and auto industry cargo was impacted. In the top 10 intermodal ramp markets, they accounted for about a quarter of our truckload market volume last week. The volumes in the top 10 intermodal ramps were up 92% week over week. The effect on capacity in those 10 ramp markets where truckload competes, rates are up 5 cents a mile to $1.88. That's about 8 cents a mile higher than the national average. Some of those ramp markets had very significant gains. And when I say gains, more so than the catch-up week after Thanksgiving, the rate of increase last week in the ramp markets was about double what we'd normally expect in a post-Thanksgiving catch-up week. Los Angeles had the highest week-over-week change at 117%. Kansas City is another very big ramp market. Volumes are up 114% week over week in the truckload spot market. One of the lanes that we look at, of course, is the Los Angeles to Chicago lane. A lot of technology-related imports, including semiconductor chips, come into the Los Angeles Long Beach market. In fact, about 92% of containerized semiconductor chips come in from North and Southeast Asia. About half land in Long Beach and Los Angeles over the course of a month. The number of loads moving between Los Angeles and Chicago, where truckload competes heavily with intermodal, increased 47% last week. That's loads being moved, not loads posted. Up 47% last week after decreasing for the prior 3 weeks, even 30% higher than the November average. Capacity was pretty good, though, for brokers and shippers. The corresponding surge in spot rates didn't materialize. However, they did increase slightly to $1.42 per mile. That's excluding fuel, while overall outbound Los Angeles spot rates for all lanes dropped 2 cents a mile. So up slightly on that intermodal lane to Chicago, but down overall. In Chicago, again, another big intermodal market. Spot rates for loads to Memphis, another big intermodal hub south. Rates are up 40 cents a mile last week to $2.39. Chicago to Atlanta, rates increased 13 cents a mile to $2.42. So pretty good evidence of the impact of the threat of the rail strike last week in the spot market. In the refrigerated sector, Atlanta was the number one market for reefer load posts last week. Volumes were up 31% week over week. Volumes in Chicago and Elizabeth, New Jersey were up also. The outbound reefer rate for Chicago, Elizabeth, and I think Atlanta were up to about $1.90 a mile, up about 6 cents a mile last week. Chicago to Atlanta paying $3.25, up 7 cents a mile. While loads west from Elizabeth, New Jersey to Chicago were flat at $1.40. On DAT's top spot market lane for refrigerated carriers between Atlanta and Orlando, the number of loads moving increased by 2% last week. Decreased by 2% last week. Rates down 16 cents a mile to $2.92. Rates not so good in Florida. Outbound average reefer rates dropped by about the same amount to $1.31. Produce season is way behind, so we're seeing plenty of capacity looking for freight northbound out of that state. In the Pacific Northwest, produce season for the fall is still underway. Volumes surged last week. They more than doubled, resulting in an increase in spot rates. Rates are up 29 cents a mile. Outbound Twin Falls to $1.72. Twin Falls to Phoenix up 11 cents a mile last week to $2.64. And even though rates on this lane have increased by almost $1 per mile since June, they're still about $1 per mile lower than this time last year. And in Los Angeles, reefer spot rates were flat at $2.01 per mile. And on the high volume lane east of Phoenix, rates decreased 13 cents a mile to $3.01. And remember, that's excluding fuel. In the flatbed market, having a look in the Pacific Northwest in Oregon, the number one state for Christmas trees, flatbed capacity tightened last week as expected. Rates are up 55 cents a mile, which averaged $2.60 overall. Load posts were up 57% week over week in Portland. Spot rates are up 26 cents a mile for outbound loads in Portland to an average of $2.59. Portland to Los Angeles, we're paying $2.13, up 10 cents a mile. Portland to Stockton, up 8 cents a mile to $2.34. Capacity was very tight in Reno, Nevada last week. There was a substantial increase in load post volumes, more than doubled, and a 51% gain in spot rates for flatbed carriers. Overall market rates for outbound loads in averaged $1.77, while long-haul loads from Reno, 3,000 miles east to Miami, were up 30 cents a mile to $1.42. Short-haul loads up $120 a load to an average of $8.24. That's about $75 a load higher than this time last year. And having a quick look in the Southwest in DAT's largest flatbed market, load posts in Houston up 50% week over week. Plenty of capacity, though. Rates dropped 15 cents a mile to an average of $2.25. Wrapping up our market update with our year-over-year look at spot rates following the short work week and carriers taking time off before Thanksgiving. A surge in spot market volumes resulted in capacity tightening for the second week following last week's 3 cent per mile gain. Remember, folks, these are line haul rates excluding fuel. The national average dry van rate ended last week at $1.80 per mile, but has decreased by about 35% since the start of the year and is now 75 cents a mile lower than this time last year. But as you can see from the chart, identical to 2018 levels. The national average line haul rate of $1.80 last week is about 30 cents a mile lower than the top 50 dry van lanes based on the volume of loads moved. So the average for the top 50 lanes last week was $2.10 per mile. In the refrigerated category, national average line haul rate for refrigerated carriers came out at $2.08 per mile last week, almost identical to 2017 and 2018 post-Thanksgiving levels. Last week, rates were down about a penny per mile in the refrigerated category. They've decreased by about 88 cents a mile since in the first half of this year, but have only reduced by about 20 cents a mile since June, boosted, of course, by stronger seasonality in the second half. Again, not a surprise there, but certainly a big drop in rates from the start of the last year. They're about 91 cents a mile lower than the start of December last year, and just 14 cents a mile higher than the oversupplied 2019 market. And in flatbed, line haul rates increased last week for the second week following last week's 2 cent per mile gain. National average for flatbed carriers was $2.07. Flatbed rates have dropped 61 cents a mile year to date, but almost all of that has occurred since June the 1st. Compared to last year, this time, last week's average spot rate is about 53 cents per mile lower. And as you can see from the chart, identical to this time in 2017, but still 17 cents a mile higher than 2019. And so that's it for this week's market update. If you'd like to find out more about what's happening in freight, go to dat.com/market update and download our weekly report, which will be published later today. And with that, it's over to Ken for the short and long-term forecasts.
Good update there, Dean. A lot to cover, I know, a lot going on. So we're going to start here with our short-term forecast. To level set everyone on this chart, the blue line is the historical rate going back to July 1st. That is a 7-day weighted moving average, excluding fuel, long haul only. This chart is for dry van. And then the colorful lines are our forecast. So the green is our ratecast forecast model. That's our flagship model that's in all of our products, our RFP tool. rate view, et cetera, et cetera. You have the red line, which is kind of hard to see here because all the models are in agreement. That's our short-term model, so that tends to much more heavily weight recent information. And then you have a gray and a yellow line that blend those other two models in varying blends to give us an ensemble here. And I think what you're seeing is, for the first time in a few weeks, model agreement. Raycast has sort of been correct over these last 5 or 6 weeks, if you will. We called that out. The short-term model is included here for a reason, and it's not included in our products for a reason. It really becomes reactionary to what it's seeing short-term, but I think it gives folks that are looking to analyze the market a really good tool set to understand both the short and longer-term seasonal approaches. But as you can see here, all of the models are pretty much predicting strength heading into the holiday season in the new year. You're starting to see at the end, though, Ratecast starting to predict that seasonal slowdown after the return period, after the Christmas holiday. So that'll be really important to watch as we keep moving week over week. We'll start to peak further and further into when the slowdown is supposed to happen. But this is the outlook for dry van. Let's look at reefer. Pretty similar. There wasn't as much of a uptick here. I'm actually surprised the short-term models reacted so strongly upward. Ratecast has been very consistent. You don't see as much of a return bump on reefer. You can't really return uneaten Christmas ham the way that you can that 9th sweater you got from grandma. So that's why you're starting to see that flattening happen a little bit more pronounced with Ratecast earlier on. But just to reiterate, I mean, this is the benefit of having a forecast model that is trained over like darn near $1 trillion worth of data. If you have kind of a wonky short-term model that's only looking at recent history, you might, I don't know, expect rates to fall 40 cents a mile over the 1 month heading into Christmas and then publish that out to your listeners. And you wouldn't want to do that. Let's go to our flatbed, which I think this one's kind of comical, just to prove that we can be a little bit self-deprecating. I think we will see some uptick in rates as we head through the holiday season, but it's really driven more by capacity coming out of the market on the flatbed side, and less due to a huge seasonal push, right? Most people aren't getting Christmas presents last minute that get delivered on a flatbed. A lot of building and stuff like that slows down through the winter. So it's a lot of capacity exiting that drives rates up. But that is the short-term forecast. And I apologize. I've been feeling a little under the weather, so I forgot we were doing a long-term forecast. But this is actually super fun. So we're going to go to the dry van spot rate long-term forecast. I just absolutely love this view. This was my favorite view when I was in the industry, and getting to see it from this side of the wall has been awesome. So a little bit more to explain here, but nothing crazy. The blue line is still the historical rate. It's the actual rate. This happens to be national dry van spot rates. This one, we're taking only very long haul shipments. So what we want to do is remove all price friction out of the mileage bands, right? So we take only shipments over 550 miles. So I would ignore what's actually on the y-axis as an absolute number and think of it more as a relative number. The gray shaded background is the year-over-year percent change. That's when you really can start to see how the freight cycle actually moves, right? The year-over-year percent change. And that's expressed on the right-hand side y-axis. And then you have all three of these models are Ratecast. So this is when you go into the RFP tool or rate view, this is what you're seeing for the high, low, medium coming out of Ratecast. And I think it paints a really, really interesting story. It's essentially saying by right after Christmas this year, we should bottom out on a year-over-year perspective and start to climb our way back to neutral throughout the course of 23. That's happening a little earlier than we are predicting as analysts here at DAT. We think there's going to be some slowness that the model might not necessarily be picking up on happening in January and February, and that climb back out might not happen until March or April. But it wouldn't be the first time that Ratecast has proved us wrong. So we're going to keep an eye on that. But this is a really awesome chart. If you want this chart or some of the underlying data behind it, drop us a line at askiq@dat.com. We're happy to provide it. Just to get to some of the stuff that Christina's worked on in our questions, I'm going to breeze through some of these other ones, but it's really interesting if you look at the reefer. The one thing I'll call out here is this little hiccup it's expecting as we head into Christmas, right? That's when you're going to see that acute push across all three model outputs to get that last rush in of refrigerated goods before the holiday. And then things they're a little bit more pessimistic as we head into 23 on the refrigerated side. And before, the raycast high output is going to be a little bit more optimistic about produce season, which I think is an interesting wrinkle. And then this is the one that is confounding us a bit. Flatbed has been giving us some things to think about, both in the historical data as well as the forecasts. And what you're seeing here is a little bit of that bounce heading into the spring with the building season, but then instead of kind of carrying that strength forward, sliding back after the 4th of July holiday. That'll really be an interesting scenario if it plays out that way. This is something we're taking a peek at, and by the next time we show the long-term forecast, we should have, I think, a better way to reason about what this is saying. But with that, we are going to go to our question of the week. Dean?
Yeah, thank you. It's a bit of a lead into Christina's update. And the question of the week is, was Black Friday and Cyber Monday a boom or bust this retail shopping season? What say you, Christina?
Well, according to the news reports, it's a boom. So I think there's so many different data sources out there that it's probably hard to pinpoint. But according to the Adobe Analytics, Black Friday was up 2.3% year over year, and Cyber Monday was 5% year over year. Granted, you have inflation involved in this, which is somewhere around 5 to 4%. So I don't know, is it flat or is it up? It's it's kind of how you look at it from a numbers perspective, but it's definitely not on the down trend from a purely numbers view.
Did you have a sense of how much heavy discounting? Yeah, because we had Amazon Prime Day for the second time, I think, ever, and it felt like we had Black Friday sales starting in August.
Yeah.
Do you think any of that had a big impact on some of the numbers?
From a discounting perspective, from what I found, is that it was real heavy in the toy sector, and electronics and apparel are the top 3.
Apparel for sure.
Yeah, but it was only 16% was what was reported, like on average, what the average discount for apparel was, but toys was in that 30% range and electronics in the 20%. But the hot products were Xbox on Black Friday. Legos were Cyber Monday. So
it's interesting.
I wonder how much. Go ahead, Dean. Sorry.
I was just saying we bought a $600 item for our remodeling of our house that we've got underway right now. And the difference was $600 between Black Friday and Cyber Monday. So we held off till the Monday, and the item, it was like a $2,000 item. We had to buy an appliance, but it was about $600 cheaper on Cyber Monday, which I thought was really interesting because normally we'd have thought Black Friday would have been the heaviest discounted period.
Yeah, I know a lot of retail. I mean, I'm a pricing nerd, right? Having kind of grown up in pricing, they sort of reserve Cyber Monday for how well their kind of rapid read on Black Friday went, right? If they had excess inventory or kind of lackluster sales on Black Friday, they would heavily discount on Cyber Monday. And there's been years where Black Friday was just lights out, and that Cyber Monday is basically nothing. I haven't seen the sales even really diminish since Cyber Monday. Now they had Cyber Week, and now there's like Cyber Month. So I think the discounting has been good. The one thing that I'm really curious about is like how much less air was shipped this holiday season than last year. That's been such a huge topic that we've been talking about with all of our shippers and a lot of our broker carrier customers, is they're shipping a lot less air this year. So where tonnage may be holding, shipments could be down considerably, which I think is an interesting wrinkle in all of this.
So that's the load consolidation factor. We saw that earlier this year, right? When the fuel surcharge escalated, shippers started to consolidate a lot more heavily.
Well, they've sort of caught up on some of the dock help and the dock scheduling. You're not as far behind. They don't have as many backlogs, so they can maybe hold freight a day to fill up the trailer as opposed to shipping, sending two, which I think is interesting. And you're still seeing a consolidated number of SKUs this year compared to years prior. You're seeing better in stock, but you're still seeing fewer SKUs industry wide than you maybe have in years prior, which allows for more efficient shipping. I think.
Kristen, any insights into what return season is going to look like this year? Because that was a big deal this year from the 2021 season. Any sense of what some of the trends will be this coming season?
For the returns, I have read that some companies want to start charging for returns. We'll see how that goes. But I know it's. I don't have a lot of detail on that other than that it's just a big headache for all.
It was about 16%, right? 16% of online sales were returned, and I think I read somewhere that could be closer to 20% this year. That's got to be a huge headache for shippers in terms of handling. I think on our side, we probably see it more in the LTL, smaller consignment space. And I'm not sure. I've not really studied how that freight moves, but I suspect it's more LTL on the return side.
I mean, it might be. I don't know how it's balanced, but it's a lot of truckload freight as well. Right? I mean, they'll fill up a whole trailer at a Walmart or Target and then send it back, because a lot of it gets returned back to their DCs, right? So it's it's not necessarily going back to the manufacturer at that point. I don't think. And then it might be consolidated and then sent back in mass. I don't know how it works once it gets back, but that's been like an interesting wrinkle with e-commerce. And some of the like the way that the returns industry has changed, because it used to be, even this wasn't that long ago. I mean, I was working in the industry. It was like once you rolled past New Year, it felt like a rock. I mean, this kind of dovetails into Kara's question, which is when does a slowdown typically happen at the end of the year? But it used to be right after the New Year, and now you see a 2 to 3 week bleed over into January while that return glut clears the system, and then it really slows down. And I think a lot of that changed because you had a lot of the big retailers using their private and dedicated fleets to handle that. And then they just realized that was typically a very slow period for the for-hire carrier. So they might as well utilize that latent capacity while it's still out there in the market. So I think that's why that big change happened, that has kept the for-hire truckload fleets and LTL carriers busy for another 2 to 3 weeks. But then it slows down.
Yeah. Kristen, one of the other topics we were talking about offline this week was the, this kind of, we've got the Trans-Pacific trade lane collapsing, volumes are down, talk of some shipping lines not being able to survive financially. Import volumes are, sort of tanking, FEU rates are dropping. One of the things you and I have been working on for a number of months now is the idea that there'll be a lot more volume nearshored to places like Mexico in particular. Anything you've got to report there that might help us understand what's going on? Because it just seems too logical to me that we shift a lot of that import volume to places like Mexico and even Canada.
Yeah, the data, I don't have all the data yet on that, but for sure that there's definitely a large increase of shipments out of the Laredo area, and even El Paso or the San Antonio area as well. We're seeing an increase. One thing I've read is for the shoring is a lot of the southern states are kind of key players in that market because of some of the employee and job market is a lot more affordable for these corporations to move those businesses, to move it to like places like Alabama and Mississippi and in that area.
It's an interesting data point. I think we're going to see a lot less volume on the West Coast and more on our southern border, and then in particular much more around the East Coast as some of those ports add more infrastructure. We'll be reporting on this next week, but the Port of Charleston just dredged their port to 52 feet, which means they can handle the Ever Given that's stuck in the Suez Canal. Some of the biggest ships in the country or in the world can now land on the East Coast in smaller ports like Charleston. So I think we'll definitely be watching that. That's a trend we need to report a little bit more on. So questions, Ken? What do we got here? Outlook on prices. Fuel prices is interesting. We had a 17 cents per mile. So Airboss Johnson asks, what is your outlook on fuel prices over the next 2 months, and how will it impact spot truckload rates in coming weeks?
You want to kick it off? You want me to
Well, I
kick
was
it
just
off?
going to say we had rates drop 17 cents this week to $4.98. So, as you said online this morning, it was the first time we've been under $5 in a while. In fact, the last time we were under $5 a gallon was October 3rd. So diesel prices are still up about $1.30 a gallon year over year, but having it under $4.98 is certainly lower where the EIA has it forecast for at the start of December. They're forecasting at the moment, and this is before last night's drop, they're forecasting $4.30 a gallon by the middle of next year. So that may change this week with that rapid decline.
Yeah, I mean, the thing with the fuel is we talk about this. There tends to be a short-term inverse impact on spot rates. So if diesel prices skyrocket, you'll see a short-term hit to the base rates. Right. Because things are negotiated all in, and then it tends to normalize, and then the inverse tends to happen in the opposite direction. So I think that those prices coming down, especially for smaller fleets, if not exclusively for smaller fleets, take some of the pressure off on the rating side, and they're able to put more money in their pockets, which I think are good. I don't think there's anyone out there except folks on a very, very healthy fuel surcharge program that want to see diesel prices stay where they are for all of 23. So I'm not good at predicting fuel prices. Neither is EIA. Neither. If you were really, really good at predicting energy prices, believe me, none of us would be doing this work. Exactly. We would be very wealthy doing other things. Yeah. I do think the one, just coming from the energy background, we always like the wild card is always what OPEC's going to do, right? And they've kind of decided for now to hold production steady. I think there's that function, and then there's still a pretty big gap between the retail and wholesale prices. So you're seeing much more responsiveness in gasoline if you're paying any attention when you're out there at the pump. Gasoline in Ohio dipped below $3 for the first time in a long time out here. But you're still seeing diesel hold steady at where I'm at is still over $5 a gallon. So it'll be interesting to see.
And but it's definitely very important. Retail and rack, right? That gap is substantial. Hard to explain why it's so big. Retail is taking a while to come down, that's for sure.
I mean, I think it's pretty easy to explain. I just think it's unfortunate that that's the situation.
So follow-on question from...
money, right?
Yeah, exactly. Yeah.
That money's not just going into like a UNICEF charity fund. To someone's, it's going in some corporation's pocket.
Well, that's part of the answer to the next question from Supreet Sunny. What effect do you think the price cap on Russian fuel will have on American truckers? And the reality, this is a strange one. The really high prices of diesel distillates on the East Coast has got refiners working at maximum capacity to produce as much fuel as they can. So inventories have actually increased. You'll recall we had the incorrect headlines that we were going to run out of diesel when it hit 25 days of supply before the midterm elections. That was never going to happen. That was an incorrect statement that the social media and some of the mainstream media lent on during the lead up into the elections. The reality is that high prices have allowed a lot of refiners to up their production, and as a result, inventories have actually increased to 29 days as of the end of November. So our inventories increasing, and the impact on us is that it's more to do with the fact high prices here have got refiners producing more product than they would have normally. So I don't know that we're going to see an impact on inventories levels, as in we're going to run out of fuel. That's certainly not going to happen. But prices will be probably stay elevated here on the East Coast in particular, because inventories are lower than in other parts of the country, because we are the furthest from the pipeline supply in the Gulf, and have been impacted, of course, by the fall off in Russian imports to the East Coast. We've got time for one more question.
Let's do the boomer bust.
Where's that one?
How does inflation play a part, or how does inflation play a part in boomer bust?
Right.
Well,
I would highly recommend. Jason Miller made a post about this 2 hours ago this morning. So the conventional wisdom holds that if inflation is really, really high, people are going to spend a lot less, right? Because their wages aren't keeping up, especially with short-term changes in inflation, right? Christine, I think that was kind of the crux of your point.
Yeah, well, we're looking at year-over-year numbers that are just solely on revenue. Revenue is up regardless of how many goods are sold because of inflation. So your inflation about 4 to 5% in these type of commodities in the retail, sector. So, if it's up 2%, in reality, is it down 2% if you subtract 4% from that? So that was kind of my thought process of some of,
Yeah. I think that's more like adjusting for inflation. That's why I say, like, you'd rather have $100 in 1919 than you would today, right? Because that was worth a lot more back then due to inflation adjusting. I don't know, Kara, if the question comes more around, typically speaking, from a macroeconomic sense, when inflation is low, people spend a lot more because it's all about trade-offs, right? The trade-off when inflation is really, really low is basically your money isn't making any money for you. You put it into a money market account or you put it somewhere else and it's just not generating a lot of return because interest rates are really, really low. So you go out and you spend, right? Your credit card APRs, your mortgage APRs are all very, very low. So you're more incentivized to spend. When inflation goes up, you're more incentivized to save. And that's actually why the Fed raises interest rates to slow down economic activity, right? So the thinking being, if things are more expensive, you won't buy as many of them, which will slow down the economy. And it will incentivize you to save, right? Because right now, I think my savings account's paying like 3%, 4%, whereas for the last 10 years, it's paid like 25 basis points. So typically speaking, high inflation slows down the economy, low inflation accelerates the economy. So there was a lot of fears that this high inflation would essentially wipe out the retail season this fall, and that just necessarily hasn't been the case. People have just changed their buying behaviors and patterns, but they're still buying a lot.
Right.
Did I summarize that well?
You did.
All right, let's wrap it up.
All right. Shout outs this week. As always, I'll be on Sales Chatter with Dan Deegan, Ryan Mohammed, and Jeff Dickinson, 9 a.m. Eastern. Tomorrow, connect with them on LinkedIn. Robert Rouse from DAT is going to be on Landline Now, Wednesday at 7 p.m. on Sirius XM. I'll be on Sirius XM channel 146 on Road Dog Radio, 8 a.m. Eastern this Thursday. Jimmy Mack, great announcer. It's going to be a fun show. Freight Find, a couple of things to note here. Freight Find's an excellent podcast that Dr. Chris Kaplis and Inam Ayu produce every second week. Ben Steffes from Coyote Logistics is on the latest edition. Make sure you catch it. He'll be talking about KPIs used within truckload transportation. If you missed it, the prior one was Scott Friesen from Echo. And coming up after Ben Steffes from Coyote, in the next edition will be Jeff Tucker from Tucker Worldwide. And that's on in about 2 weeks. Remember, you can find out all about this week's market update at dat.com/market update or on our new IQ dashboard at iq.dat.com. And with that, it's back to Ken to wrap up this week's show.
I always ask you, Gene, but who do we have next week on this program?
Tim DeNoyer, Vice President at ACT Research, next week.
We just have this litany of just superstar guests, present company included. We're very fortunate to have people willing to take time out of their busy days and even get out of bed really early if they're on the West Coast or in the mountains to join us. So we're thankful for that. And it's always a great conversation with Tim. So with that, we are going to wrap up. We will see you next Tuesday at 10 a.m. Eastern. Think about those questions. Tim's an expert on that kind of supply side economics of trucking. So think about those questions that you want to ask, and we hope you can join us next week. Have a great week, everyone. Bye.
Thanks, everybody.